This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 39. Should short selling be banned?
Hello, welcome to the Debunking Economics Podcast. I'm Phil Dobbie with Professor Steve Keen again, of course, and today we ask, should short selling be banned? Well, maybe not. Listen to find out why. A big chunk of the trades that happen in shares, or in many things really, are sold short. In other words, the trader takes the punt that the price is going to go down. In effect, you sell something that you don't own yet, like shares in a company, and you sell it to some mug who buys it off you at today's price. Then when the price has gone down, you buy it at the lower price and deliver on your promise. It's a bit like telling your mum that you've bought her an air ticket, telling her how much it costs, getting the money off her, then buying a cheaper ticket for the same flight and pocketing the difference. But does that make you a good person? Well, possibly not. So is short selling a bad thing, or just another neat way of making money? Well, Professor Steve Keen is with me. Some would say, look, if you're smart enough to read the tea leaves and know a price is going down, then that's fine. Why is it any different to investing expecting a price to go up?
Well, it's in both cases what we've got is leverage speculation on the stock market. And this is by far the largest volume of money that's on the trade stock market. Is not actual people's money. It's money they've borrowed to gamble and speculate. For example, I know that one of the major forms of share trading these days is what they call high-frequency trading, and some of the high-frequency traders are geared 5-to-1. So not only are they buying and selling, trying to ride seconds ahead of the microseconds ahead of movements in the actual market, they're doing it with levered money. Right. And this is the real danger. It's the amount of leverage there, whether it's leverage up or leverage down. But what the short sellers, of course, the story of ripping off your mum like that is a good one to start, because people normally talk about evil short sellers. When what actually happens is when somebody has worked out that there is some argument that they think is how the prices are going to collapse for a share which everybody else thinks is going to rise, and they then borrow shares they haven't got. So this is the real thing with short selling, is you're selling stuff you haven't got, as you say, you haven't actually bought the things yet, and your idea is to borrow the shares from somebody else at a current price. So you're paying a rental price. Let's say you're even paying 10% of the face price of the share over a year. You buy it for the 10% of that price. Typically, it's a servicing cost. You hope to get rid of it within the year, and if it goes down by 50%, you make a gain on money you haven't actually laid out yet. And then when that actually happens and goes correct, of course, the short sellers are the ones who cop the stick from the media. But their attitude is, well, we're actually the garbage collectors. We're out there saying what stinks behind the roses, and if we're right, we clean out the crap in the market. And of course, short sellers made a fortune during the bust of the dot-com bubble, and also during the bust of the subprime bubble.
Well, if we paid attention to them, maybe we'd stop some of those. Maybe people would get alert to some of the intrinsic problems. So maybe they are serving a useful purpose. I mean, for example, they're stopping people manipulating the market upwards. I mean, they are perhaps a useful counter to that.
Well, in fact, when they're doing their buying, they're in fact adding to part of the buying pressure as well. So the market is a very, I have not traded actively in the stock market. I could have got into that game, but I've seen it swallow people completely. And my stuff is more about analysing the direction of the market, so what's driving the economy, rather than trying to make profit out of the whole idea. But the amount of leverage that ends up in that system, and the amount of volatility it creates, and of course the reality, when you're talking about short selling, you're talking about something which, according to conventional economic theory, does not exist. Yeah, you look at it and say, well, you're imagining that leverage and short selling and people going long as well, of course, all these things don't exist. You're imagining there aren't battles between bulls and bears. In fact, that's what dominates the markets. And things like short squeezes, of course, are another part of what we don't hear about. But if you believe that shorts are exposed to a large loss, frankly, I don't know the mechanism all that well because I don't follow it carefully. But people who actually think the market's going to go long can actually then manipulate the market to make it go higher and force the short sellers to cover their positions, which meaning they're losing money overall. So these battles are really what's going on in the stock market. It's not at all the polite place of economic theory. It's a war zone.
Yeah, it certainly is that. But I'm just wondering. So should we get rid of it? I take your point that whether you're punting on shares going up or down, if you're doing it on leveraged money, that's not particularly beneficial to society or to the necessarily for the companies that you're investing in either. And we'll park that idea because we're going to talk about that in the next podcast. But is I'm just trying to get to the roots of whether short selling is a good thing or a bad thing. Because on the one side, it sounds wrong because of that idea I gave, about selling the wrong priced air ticket to your mother. But on the other side, I'm wondering whether it actually helps stocks. Because if I sell short, I need to buy those stocks at a lower price. If enough people do that, then you start to push the price back up again. So I'm wondering whether it also has a bit of a balancing effect on the share market.
Well, I mean, the real argument, and I think I'd really recommend people watching shows like Margin Call and The Big Short and so on to see what actually goes on behind this stuff, because the short sellers are frequently people who think, well, there's a delusion loose in the market. There's deluded attitudes about how far these shares are going to go. Everybody thinks they're going to continue rising. And you also have a lot of short sellers go inside and look at the actual books of these firms and go and knock on the shop fronts and see what's actually happening. There's a marvelous scene in the Big Short, which is a genuine historical act. And there was a conference of people in subprime markets I think it was in Las Vegas. Where else would you hold such a thing? And one of the lead characters, rather dysfunctional personalities in the Big Short, is there interrogating some particular broker who's selling shares mortgages hand over fist to what they called ninjas, no income, no job, no assets borrowers, making an absolute fortune. He's picked up in a giant limo after the whole conversation and in the actual movie. And the guy who's just doesn't believe this stuff is actually happening walks away from the conversation and says to his colleagues at another table, I'll short everything that guy's involved in. Find out. In other words, there's such a level of delusion and bullshit behind this guy that he says, I'm going to back him to crash. And of course, he did crash. Grand scale, and the short sellers made money out of the crash. Then they get criticised. But of course, what they've done is they've gone inside and investigated and said this stuff is garbage. Yeah. And they were right.
So they've done the hard work. So I mean, it's in some ways it's harder. I mean, it's harder to make money, I'd imagine, out of selling short than it is out of pushing stocks to speculate upwards.
It's very dangerous. This is the problem about it, because you can be right and wrong by one day in timing, you get wiped out. There was a guy called Sykes. I've forgotten his actual proper name now, but he was a industrialist who got involved with the Australian Labor Party and established a whole range of petrol stations to try to reduce the cost of petrol for workers. There's a joint venture with the Australian Council of Trade Unions. And he was convinced that the oil price he thought was far too high. So he was shorting the oil price and expecting it to fall. And of course, if it did fall, he would have made a large amount of money. It did fall, but after he'd gone bankrupt. Now, this is the great trouble. When you're short sale, you're exposed to, if the market continues going in the insane direction for long enough, your timing, your capability to cover that short just doesn't exist. So at some stage, you're actually promised to sell shares you haven't got. The time of that sale approaches, you haven't got the shares, you've got to buy them, you're forced to go and buy them on the market. That's actually now worked out. Remember what a short squeeze actually is. So in that situation, you're forced to buy. And of course, in that position, if people realize that you're a major factor in the market and you're a short trader, then they will themselves go in and buy into the market as well to force the price to go even higher, which is what they call a short squeeze, and that can bankrupt you. No. So it's not for the faint-hearted.
No, it's not. And also, it's hard work, as you've said. You've actually got to do the research. If you've got a stock that's $20 and you're selling it short, the most you can gain is $20. You're not going to make that because obviously that means that it's collapsed to zero. But if you had a $20 stock that's on the rise, then the gains are limitless. So in theory, so it's not the most lucrative approach. Surely, if you are wanting to game the stock market, you'd be looking and saying, well, okay, let's look at stocks that are on the rise rather than stocks that are on the decline. So I'm just wondering whether short selling is the root of evil that many people paint it to be.
I don't believe it is. And the reason that it isn't is that when you look at why people say it's evil, they think, well, stocks should rise in price over time. There should be an increase in prices, and you guys are causing it to go down, so we hate you. But the reality, when you take a look at it, well, what is the justification for share prices rising? Now, there are justifications that don't exist in the case of housing, and we'll talk about that in relation to the Jubilee shares probably in that other blog and the other podcast.
In our next podcast,
Yeah, but the expectation that they should rise is why people criticise short sellers, because, of course, short sellers only profit if it goes in the opposite direction. So in that sense, they're the outcasts, and that's one major reason why they get the level of opprobrium they do. But the level of danger they're taking on to actually be short sellers is astronomical, and nobody ever cries for a short seller when they get killed in a short squeeze. People only cry about a short seller and they make an absolute fortune when the delusion that they've identified actually turns out to be correct, that it is a delusion, and their timing is also correct, and they make an absolute killing, as they did back with the subprime.
Yeah, so they're doing some good, and yet there's been lots of instances when short selling has been banned. I mean, apparently Napoleon considered it unpatriotic and treasonous. And if you sold short in those days, you'd end up in jail or worse. And in Malaysia, even in the 1990s, you could face the cane for selling short. So we don't like short sellers. We seem to think that they're doing no good at all.
Yeah, and they're basically the outlaws. And it's outlaw treatment of them, which reflects the fact that there is an inside school as well. And the inside said these prices should always rise. Now, that's what gives rise to bubbles. And if you had the bubbles without the short sellers, then maybe the decline from the bubble would be less extreme. And that's why people get so angry, because the majority of people have got themselves locked into expecting share prices to rise. When it's not just an individual share that goes down, but a systemic decline, and something like the size of the subprime market is big enough to cause a systemic decline, even if it were relatively isolated from the rest of the economy. It's such a big part of the market that it will cause the whole market to go even so. And then, of course, there are flow-on effects, so it affects the entire economy. The steepness of the decline is more extreme given the existence of short sellers. And then, of course, they're the ones who are joyful, but everybody else is crying, and that's when the mob turns ugly.
Yeah, and yet they might have. I mean, of course, we talk about banning short selling from time to time. Normally, when we fear that people are talking the market down, but I mean that in itself means that probably those short sellers are stopping not stopping bubbles from happening. But perhaps they're stopping them being quite as extreme. You know, maybe they would be bigger than they are. Not only will the slide off it be more gradual, but maybe the size of it might be larger without short sellers.
We're trying to maintain a level of overvaluation. This is the whole problem. I actually think the root problem is not that there's short selling or even that there's people taking long positions. Is that we're doing it with levered money into the stock market, and that means nobody lets you go into a casino with a credit card. One thing we've managed to prevent socially is people using their credit card to go gamble. If you want to go and gamble in a casino, that's fine, but you've got to take your own money. Okay. Now that is a very sensible attitude of what is actually a den of gambling. And frankly, that's the same thing overall the stock market actually is. It's not somewhere that actually generates money for firms. The amount of actual capital raising that goes on the stock market is absolutely trivial. 99% of the volume is people gambling about the direction of prices of existing shares. And this is, again, one reason why I want to redefine shares, as we'll talk in the next blog post. But in that world, the danger is not so much that there's short sellers. The danger is that we're doing whatever we do is short selling or taking long positions with levered money, which therefore exaggerates the ups and downs of the stock market.
I just had a great idea, actually, just talking about that, seeing people going into a casino ready to lose money. Wouldn't it be great to actually be gambling on how much money each person was going to lose? That's almost like a sort of a form of short selling. We're gambling on the gamblers.
Well, that's exactly what does happen. And this is the other thing, where we talk about the positions people take with contracts for difference and stuff of this nature, where you're gambling on the direction of other trades and other shares, so you're levering on more and more elements of gambling on top of it. Again, The Big Short does a wonderful job of portraying this. I've forgotten the actual actress they use for it. They've got, what's the name, that gorgeous Australian actress who plays in Scarecrow, whatever she's called. I can't think of her name. She turns up at one stage in a bubble bath and then tells you to fuck off after she explains a particular aspect of it. Yeah. They've got another one where they're watching people betting positions on a roulette wheel, and then people are betting whether the better on the roulette wheel is going to actually get the black or the red or not. And what turns out being like $100 bet for the person on the roulette wheel becomes a $10,000 bet and $1 million bet, cascading off the system. And this is the real danger. One person I know who learned a lot about the reality of how much gambling actually goes on in stock markets rather than what they're portrayed as being, which is ways to raise investment capital for genuine corporations, was John Kay, a very classical mainstream economist over here in England, in the UK. And John finally realised that finance was a force for evil, effectively, rather than a force for good, when there was a petrol, what do you call those things, the oil rig that collapsed in the North Sea. I think it cost something of the order of 700 million, and the losses that came out of it were closer to 10 billion, courtesy of all the leverage that had been built up with people taking gambling positions on these assets. So he realised that rather than being a stabilising force, which is the way the mainstream portrays finance, and rather than being efficient, it actually was massively amplifying the level of losses that finally occurred.
Right. So, in conclusion, I mean, we know, and we'll talk about it next time, that the share market is a bit of a Ponzi scheme. It's driven off leveraged debt. But so long as we've got it, talk about trying to ban short sellers is probably a bad idea, because in a way they may be a useful check and balance.
They're the garbage collectors. They're the ones that actually say that what you think is a rose is actually a stinking heap of cattle dung, which is about to explode on you.
Right.
So and if they didn't have again, this is the part of their own rationale as well. If there weren't huge profits to be made out of it, then they wouldn't be doing the work in the first place, and we'd end up being even more diluted. We'd end up paying rather than paying a house and a cart for tulips, a single tulip, we'd be paying all of Amsterdam for a single tulip. So they do have a point in which they say they do limit the extent to which they get extreme overvaluations in the market. But the market still has them, and it's still over-levered.
Yeah. All right. Okay. But they are garbage collectors, but we need more of them. All right. Very good. Look, we will talk, as we mentioned, we're going to talk about the idea of Jubilee shares next time. Is how do we stop this Ponzi scheme that is the share market? How do we try and relate it back to the values of the companies that we're investing in? We'll do that next time. Thanks, Steve.
Okay.
And that is the Debunking Economics podcast. I'm Phil Dobbie. That was Steve Keen. Catch you next time.